Seems to be this fear sort of gripping Dalal Street. What is the basis of that fear? Before I move on to stock action today, the big crash, the revival that we saw towards the end. But what is it that's gripping the markets as far as the fear factor is concerned?
My sense is the nervousness that the market has been facing for the last few days, apart from the currency and everything else, revolves around the lack of liquidity in the system. So liquidity has been low for a while. One of the papers of one of the companies was sold today in the market at a much higher yield than the market expected, and that caused panic. And I think that panic, so people sort of overreacted to the panic, and that overreaction is what we saw reflected in market performances today, with stocks going all over the place. So I think fundamentals have not changed. There is nothing that is fundamentally wrong in the economy. There is no imminent risk of any major default happening other than whatever one has heard of ILFS. But other than that, there is no risk of any paper getting significantly downgraded or anything of that sort. So I think it's a knee-jerk reaction of the market based on the sheer fact that one of the company's paper was traded at a much higher yield than what the market was expecting.
But Keki, DSP mutual fund selling DHFL paper at 11% in the bond market can't. I mean, is our market so fragile that the intraday swing is about 1,500 points? I mean, the markets at one point crashed 1,000 points. So, I mean, are our markets so fragile, and is the knee-jerk reaction then? I mean, how do you explain that knee-jerk reaction unless they are more worried about more defaults or the worsening macros?
Absolutely. So the market was worried at that time. It's a knee-jerk reaction of the market based on the belief or based on the fear that a lot of the mutual funds had lent short-term money to a number of these NBFCs, and when the short-term money came up for maturity, the paper would not be renewed, and if the paper was not renewed, then it could theoretically result in a further liquidity crunch in the system, and the concerned company would not be able to pay the mutual fund, which in turn could lead to defaults. I think that is all market conjecture. To my mind, yes, I'm sure some of the non-banking finance companies have a lot of short-term paper, but I'm sure they also have assets. You have to look at each company and see what kind of assets, liabilities they have. But I'm sure they also have assets to be able to support the liquidity requirement.